Hello, and welcome to the Money and Banking Law Podcast with Joe Sylvia, brought to you by Duane Morris, an international law firm with roughly 30 offices and 1,000 lawyers all over the world. I'm your host, Joe Sylvia. I'm a former Federal Reserve lawyer who represents banks, fintechs, and financial services clients on M&A, payments, and regulatory matters at Duane Morris. I'm also a core member of our banking, fintech, and digital assets and blockchain practices. Now, while we can't provide legal, financial, investment, or tax advice on the podcast, our goal for the Money and Banking Law podcast is to inform and educate our clients and friends on both the fundamental concepts and structure of the banking ecosystem, as well as critical developments in the law and regulation of money and banking. Thanks for joining us today. As always, if you have any questions from any of our podcast episodes, please reach out to me at jsylvia@duanemorris.com. On today's episode, we're going to be talking about Vice Chair for Supervision Mickey Bowman's recent testimony and the release of the Federal Reserve's Supervision and Regulation Report in June of 2026. Okay, so what was interesting about Mickey Bowman's report and testimony is a couple of different things. She first kind of went through some of the current banking conditions in the United States and indicated that right now the banking system remains sound and resilient. She talked about strong capital ratios at financial institutions in the United States and significant liquidity buffers. But she also talked about recent developments. She talked a little bit about innovation. She talked about some of the things that are in the Supervision and Regulation Report that I'll mention in a minute. But I wanted to run through her testimony first and just kind of give an overview of some of the thoughts that came to mind when I was looking through this. So she talks about banking conditions, but within the banking conditions, she also mentions the competitive landscape that banks are seeing and as it evolves, and specifically with respect to non-bank financial institutions. She mentions that they are capturing a growing share of the lending market, which is true in the United States. It's, they're competing and she says displacing traditional banks in some cases without facing comparable regulatory standards. So, what's fascinating here is that she's kind of calling these non-bank financial institutions out and saying, hey, you guys are competing with banks, especially in the lending context, but you don't have the same regulatory standards or expectations. So this is something that we need to be looking at in terms of the growth for the future. She indicates that the financial system is continuing to adapt and evolve to technological advances. She mentions the rapid evolution of AI capabilities. And here, I think there's kind of a glimpse into the supervisory expectations and maybe supervisory priorities to some degree for Vice Chair Bowman, because with respect to these technological advances, what she talks about after indicating that there's adaptation, there's rapid evolution, so on and so forth, is she talks about cyber vulnerabilities and the need to identify the new vulnerabilities and the potential for cybersecurity attacks and cybersecurity issues and threats. So if I'm a financial institution in the United States, that's one thing. Obviously, you've likely been paying attention to that already, but that's definitely something to take away as a potential supervisory priority for the Fed and I think for others as well. In terms of recent developments, she talks a lot about the capital regulations and how they've been changing, how they look like they're changing based on what the Federal Reserve and some others are doing. She talks about the community bank leverage ratio. She says the community banks generally remain a priority for the Federal Reserve. The Federal Reserve's supervisory and regulatory framework needs to be appropriately calibrated to support the growth of community institutions and community banks, while also maintaining safety and soundness standards. One of the things that I've mentioned before and that Vice Chair Bowman talks about a lot is tailoring. And that's that idea, the concept of tailoring or kind of customizing the supervisory process and expectations for banks based on their size and complexity is something that flows throughout her testimony, or her prepared remarks, at least for her testimony. She goes on in recent developments to talk about the capital framework modernization beyond just the community bank leverage ratio. She talks about how there's been proposals out now, or there are proposals out now to try and align risks, reduce overlaps and duplications, and support extensions of credit to the U.S. economy, especially in mortgage lending context, while still preserving strong capital levels. The proposals to modernize the capital framework. They want capital to flow more efficiently while maintaining strong prudential standards that protect financial stability. These are her words through her testimony. Supervision improvements in terms of what she's hoping for and what she's looking for in the future. She's saying at the Federal Reserve, they continue to advance risk-based tailoring that matches oversight to each bank's size, complexity, business model, risk profile, and so forth. So again, on this tailoring kind of concept that she's focused on. She wants to focus the supervision and the Federal Reserve supervision on material risks to a bank's financial condition and overall strength. So we've seen each of the agencies kind of come out with a perspective that going forward, and each of the agencies, I mean the Federal Reserve, the OCC, and the FDIC, come out with perspectives on supervision that are going to be focusing or tailoring their supervisory priorities on material financial risks to banks and other financial institutions. The Federal Reserve has conducted a comprehensive review of all outstanding matters requiring attention, which are known as MRAs. And what Vice Chair Bowman says is that the findings revealed that many previous MRAs cited procedural or documentation deficiencies instead of actual threats to safety and soundness or identifications of material financial risks. So this is one of the justifications, one of the support mechanisms for recalibrating, she says, our approach to prioritize what truly matters and apply appropriately tailored expectations. The next thing she mentions is the proposal out now to revise the CAMELS rating framework that has been largely unchanged since 1979. She says that the revisions introduce clearer, more objective metrics for each component, and they replace subjective management assessments with measurable factors. The approach, she says, ensures ratings reflect the bank's overall safety and soundness rather than isolated or process-driven deficiencies. She goes on to talk about innovation and talk about the path forward. Again, with respect to innovation, she's open to it. She understands there are challenges. She's also identifying paths forward where there's more tailoring, where there's updates to thresholds. For example, with Regulation O, she says the thresholds haven't been updated in several decades, and they may have been reasonable at the time. They discourage right now well-qualified local business leaders from serving on community bank boards, and they're really limiting the access of bank boards to valuable expertise and valuable governance experience because of what some of these lending standards and restrictions apply to in terms of the thresholds. She goes on to talk more about tailoring requirements. She talks about payments fraud, and she closes by saying that basically the things that she's talking about reflect a fundamental principle, and that is the following: appropriately calibrating regulatory and supervisory requirements strengthens both financial stability and economic growth. Now, by tailoring requirements to actual risk, focusing supervision on what truly matters, and integrating innovation into the regulatory framework, the Federal Reserve is creating conditions for banks to thrive while maintaining the robust safeguards that the American people expect and deserve. So again, more focus from Vice Chair Bowman on updates to regulations, tailoring regulations, and tailoring the supervisory process to a large degree. So I mentioned in coincidence with, or in coincidence in conjunction with her testimony, the Fed released its semi-annual supervision and regulation report. I've got a copy of it here. I just wanted to mention a couple of the supervisory developments that are outlined in the report. And, their supervisory efforts, there's a kind of an overview of what supervision looks like generally from the Federal Reserve. But then they go into supervisory priorities, which I don't think they really should surprise anyone. But for example, in the community bank organizations and the regional bank organizations, the supervisory priorities focus on credit risk, liquidity risk, IT, and cyber risk. So again, what we've seen with what was in the outline of the testimony. For large financial institutions, the report indicates that they focus on four components for their supervisory efforts. One, capital planning and positions. Two, liquidity risk management and positions. Three, governance and controls. And then finally, four, recovery and resolution planning. Now, the supervisory focus for large financial institutions in terms of the priorities are focused more on capital planning and positions, liquidity risk management, operational resilience, counterparty credit risk, interest rate risk, technological change risk, again, talking about innovation and stuff like that. And then finally, recovery planning. So a lot of really good insights, good information in the supervision and regulation report. There's a whole section, as there usually is, about bank applications and mergers and acquisition applications, focused on what applications are coming in, how long it takes for the Federal Reserve to review them, approve them, how many are withdrawn, a lot of good information. So, this was released on June 4th. It's now the 12th of June. By the time this gets posted, probably the 15th, 16th of June, something like that. So it's been a couple of weeks. The information is there and available for the public's consumption. I would definitely suggest taking a glance at the supervision and regulation report of the Federal Reserve. It's a helpful document to kind of focus the efforts if you're outside third-party advisor or if you're in-house at an institution, help you focus a little bit on where the supervisory focus is going to be, where the supervision priorities are. It also tells you where the folks supervising you think that the risks might otherwise be focused at this point. So definitely things to consider. I'll end there. If you have any questions on this podcast episode or any of the others, please feel free to reach out to me at jsylvia@dwaynemorris.com or any of the other favorite Dwayne Morris lawyers. Please be sure to like and subscribe wherever you do get your podcasts. And for the rest of the day, have a great day, great weekend, wherever you are. I'm here while my son practices golf. My daughter has golf lessons. I'm here working, but it's beautiful outside, so I can't complain too much. Until next time, guys, really enjoy it. And please be sure to like and subscribe, and I'll see you next time. Thanks.